Welcome to the Deep Dive. We're your shortcut to being truly well-informed. Today we're taking a close look, a real deep dive into the Austin housing market. It's seen some incredible shifts lately. Our mission here is really to cut through the noise, the headlines, and help you understand the surprising facts, the key trends shaping Austin real estate right now in mid-2025. We pulled together quite a stack of sources for this one, a recent piece from Team Price Real Estate, the big July 2025 ICE Mortgage Monitor report, and some really granular sales and Realtor data too. So yeah, get ready to have some maybe preconceptions challenged. Okay, let's jump right in. The first thing that just leaps out from the data is this pretty dramatic home price correction in Austin. We're talking prices down nearly 20% from their peak back in May 2022. And to make that real for you, that's an average loss of over $117,000 in home value if you bought right at the top. What really stands out, though, is not just a local dip. This is actually the sharpest drop among major U.S. markets. Way more than, say, Cape Coral, Florida, which was down about 13.3%, or even San Francisco at minus 8.9%.
Right. And what's fascinating, truly fascinating here, is that this isn't just some isolated blip. It feels like a leading indicator, you know? It shows what happens when supply really surges. The core driver, the absolute main reason for this price drop, is a huge increase in available inventory. Looking at the ICE and Realtor.com data, the supply of homes for sale is, get this, 69% higher than pre-pandemic levels.
Plus 69?
Yeah. It's a massive number, a complete reversal from that pandemic frenzy we saw. It's fundamentally shifted the power dynamic, you know, from sellers to buyers, and that's put sustained downward pressure on prices for, well, over 2 years now.
Okay, so prices falling as sharply. So let's talk about the ripple effect, the impact on homeowners. Because here's where it gets, I think, really interesting. These falling prices create a very real problem.
Yeah.
Negative equity. Just quickly. Negative equity, that's when you owe more on your mortgage than your home is actually worth on the current market. Now, the overall rate in Austin across all mortgages is 4.2% underwater, which, you know, isn't nothing. But here's the kicker. For people who bought in 2022, that rate skyrockets to 18.2%. Almost 1 in 5 homeowners who bought near the peak are now underwater. And it's even worse for FHA borrowers from 2022, those often using lower down payments. A staggering 65% of those loans are underwater. 65.
Yeah, it's incredibly high.
And putting numbers on that, it's roughly 6,200 home buyers from 2022 now underwater, and about 1,100 of those are FHA loans.
That distinction is so critical. The practical side of being underwater is, well, it's tough. It severely limits your options. Refinancing, difficult. Selling without bringing cash to closing, often impossible. Tapping home equity, forget it. Now, it doesn't automatically mean foreclosure, let's be clear, but it absolutely signals increased financial hardship, especially for those with little or no equity buffer if, say, their income changes or rates go up again. And connecting this to the bigger picture, ICE's research shows that nationally, 92% of all underwater mortgages originated in 2021 or later.
92%. So it really highlights the vulnerability of peak buyers.
Exactly. Those who bought during that pandemic surge. And Austin, while leading the drop, isn't totally alone in this negative equity situation. We see similar hotspots like Cape Coral, again, 7.8% overall negative equity. Nearly 70% of recent FHA loans underwater there.
Wow.
And even closer to home, San Antonio is sitting at about 4.3% negative equity.
Okay, so if almost 1 in 5 recent buyers are underwater, how's that squeeze affecting, well, everything else, the market's ability to function? What does this mean for sales, for activity in Austin right now? Looking at the July 2025 data, year-to-date, just over 17,000 homes sold in the Austin area. That's down 7.4% from last year. Still, interestingly, about 4.8% above the long-term average. But monthly sales for July itself, just under 2,400 properties. That's down 15.2% year over year, and also 14.2% below the historical average for July. So a definite slowdown there. We're also seeing price growth basically stall out. In early June, Austin home prices, seasonally adjusted, rose just 0.02%.
Tiny.
Yeah, tiny, like an annualized rate of 0.3%. Stagnation, really. And it's interesting, too. The market seems segmented. Single-family home prices, still up 1.6% year over year, but condo prices actually fell by 1.3%. So softer demand in that condo segment.
And this cooling, this slowdown, it isn't even uniform across the area. When you dig into the hyperlocal data, it gets pretty stark. If you compare specific cities and zip codes, July 2025 versus July 2024, the year-over-year drops in sales volume are severe. The average difference across these pockets is a massive minus 88%.
88%.
88%, yeah. So take Austin zip code 78702, for example, down 90% in sales year-over-year, Buda, down 93%. Georgetown, also down 93%.
It's basically grinding to a halt in some places.
Pretty much. It tells us that while Austin overall is cooling, some specific neighborhoods, some communities are seeing transaction activity almost completely freeze up.
That local data is just,
Yeah.
eye-opening. Okay, let's step back a bit now. How does Austin's unique situation connect to the wider national mortgage and housing picture? What's the ICE Mortgage Monitor telling us broadly?
Nationally, inventory is actually up 32% year over year, and it seems like it's on track to get back to pre-pandemic levels maybe by the fall.
Right, a different story nationally on inventory normalization. Yeah. And on interest rates, they did trend a bit lower towards the end of June, hit 6.76%, lowest since early May. Market chatter, expectations, they're pricing in almost certainty of at least one Fed rate cut by the end of 2025. Baseline seems to be maybe 3 cuts, which suggests an implied 30-year rate just over 6.4% by mid-December.
And that slight dip in rates, or even the expectation of future dips, is definitely influencing behavior. It's driving an uptick in what we could call affordability workarounds. We're seeing adjustable rate mortgages, ARMs, gain popularity again. Over 5% of purchase loans, nearly 9% of refinances, highest share since late 2023.
Okay.
And temporary rate buydowns are still quite popular too, where the seller or lender helps lower the rate for the first year or two. The 2-1 buydown is the most common rate, is 2% lower year 1, 1% lower year 2. That's about 60% of buydowns. Then 1-0 buydowns are second, about 30%. Add it all up, and you've got more than 8% of borrowers using other ARMs or these buydowns to, make the numbers work.
So even with these strategies, are people really stretching themselves thin to buy? Is affordability still a major issue?
Oh, absolutely. Underwriting standards are still tight, don't get me wrong. Average credit score is high, around 738 for purchases. But affordability itself, still very, very stretched. Look at the average back-end debt-to-income ratio, DTI. That hit 40% in May.
40% of gross income just on debt payments.
Exactly. Nearly its high from late 2023. And this is happening with average loan amounts over $375,000 and average loan-to-value ratios over 85%. So, yeah, it definitely raises that question, just how sustainable are these current affordability levels and the measures people are taking?
Right. And speaking of financial strain, you mentioned the ICE report touched on student loans.
Yeah.
Collections restarting in May after that long pause. Sounds like that could be another pressure point, especially for some homeowners.
It really could be. About 20% of all mortgage holders also have student loan debt. And for FHA borrowers, it jumps to nearly 30%. And here's the worrying stat. People who are past due on their student loans, they are up to 4 times more likely to also be past due on their mortgage. So it's definitely a key area to watch for signs of emerging financial stress.
Got it. On a slightly different note, though, operationally, the ICE report did mention things are moving faster. Closing times are down.
Yeah, a small positive note in there. Efficiencies seem to have improved. Average loan closing times in May were the lowest for that month in over 6 years, about 41 days after application, just under 30 days after the rate lock.
So quicker process, at least. Okay, bringing it back home to Austin for the final piece here, the human element, the real estate professionals themselves. What's happening with realtors? The data shows Austin MLS Realtor numbers are at just over 18,600. That's down about 12.4% from the peak back in September 2022. Still high historically, though almost 40% above the long-term average.
Right. Still elevated, but definitely shrinking.
Yeah. But look at sales per realtor. That really tells a story. Sold properties per 1,000 realtors in July 2025 was 128. It's down over 10% from last year and way below the historical average, like almost 39% below, depending on how you measure the average. Fewer sales, fewer active realtors, clear sign the market's recalibrating.
Indeed. And synthesizing all these trends, what it really means for anyone involved in the market, buyers, sellers, even current homeowners just watching, is the crucial importance of focusing on local data and long-term trends, not just flashy headlines or broad national narratives. Austin's undergoing a really unique correction. Understanding these specific granular dynamics is absolutely paramount now. It's a definite shift from that kind of generalized frenzy we saw to a much more localized, nuanced reality on the ground.
So to recap our deep dive today, Austin's standout price correction, the significant negative equity issue hitting recent buyers particularly hard, and these broader shifts we're seeing in inventory, lending practices, and even the professional landscape. It's really clear Austin is carving its own path right now in the national housing story. A fascinating case study, really.
Absolutely. And maybe the final thought to leave you with is this. Given all these nuances we've explored today, these shifts happening at both the hyperlocal Austin level and the national level, how might understanding them inform your strategy, whether you're actively planning a move or maybe just trying to keep a pulse on the economy? How does this change your perspective moving forward?
That's a powerful question to mull over. Thank you for joining us on this deep dive into the Austin housing market. We definitely encourage you to keep digging into these topics and stay informed.